Accounting 101. Today, we're going to tackle about the cost accounting and the cost accounting cycle. Now, what is cost accounting? Cost accounting is a process of ascertaining and accumulating the cost of product or activity. It is a process of accounting for the classification, analysis, interpretation, and control of cost. So, it is a system of accounting which provides information about the ascertainment and control of cost of products or services. It measures the operating efficiency of the enterprise. It is an inner aspect of the enterprise. Cost accounting is the process of accounting from the point at which expenditure is incurred or committed to the establishment of its ultimate relationship with cost centers and cost units. In the widest usage, it embraces the preparation of statistical data, application of cost control methods, and the ascertainment of profitability of activities carried out or planned. Costing includes the techniques and processes of ascertaining costs. Principles that are applied for ascertaining the cost of products, jobs, processes, and services. The process refers to the day-to-day routine of determining the cost within the method of costing adopted by a business enterprise. Costing involves the classifying, recording, and appropriate allocation of the expenditure for the determination of cost of products or services. The relation of these costs to sales value and the ascertainment of profitability is that cost accounting, a subject that provides management with information relating to costs, is a service to management. Management of a manufacturing or service organization, private sector or public sector organization, profit-making or non-profit making, military or civilian organization would make sure that cost accounting is accorded to the necessary attention it deserves. What is cost accounting cycle? Well, cost accounting cycle is a process performed during the accounting period in recording data, classifying, determining total cost, determining product cost, determining selling price, controlling cost, and decision making. Here we have our cost accounting cycle and how it flows from the start until the last. First is the recording of cost data. At the first step of the cost accounting, it ascertains and records the element of cost for determining of cost of production. Second would be the classification of cost. Here at this second step, according to function, nature, and behavior cost, accounting classifies the cost. And on the third step, we determine the total cost. In this step, under cost accounting, cost of goods sold of a product is calculated. The cost of goods sold means the sum of all items of expenditure incurred in production for the goods which are sold. Next would be the unit cost. In this fourth step, the unit cost is obtained dividing the cost of goods sold divided by the total number of units sold. And on the fifth step, the selling price. The selling price is obtained by adding a profit margin with the cost of sales. And lastly, in the cost accounting cycle, we have the cost control and the decision making. At the last step of cost accounting, by using standard costing and budget and budgetary control system, cost accounting control cost and make a decision. The period covered by the cost accounting cycle means the time period covered by an income statement. Generally, cost accounting department prepares income statement on monthly basis, as the length of a month varies from 28 days to 31 days. Cost accountants sometimes divide the year into 13 equal periods of 4 weeks, thus making the income statements and other reports more comparable. It is common to take 1 month as accounting period to demonstrate the cost accounting cycle. The control accounts used in cost accounting cycles are: first is the material control account, second would be the payroll control account. Third would be the factory overhead control. Fourth would be the factory overhead applied account. And fifth, work in process control account. Sixth would be the finished good control accounts. Seventh is the cost of goods sold control account. Eighth is the sales control account. Nine is the sales overhead control account. 10th, administrative overhead control account. And lastly, the income summary account, which is to close accounts of expenses and revenues at the end of the accounting year. Now, how is the accounting cycle different from the budget cycle? The accounting cycle and the budget cycle differ in their timing and focus. The accounting cycle records and reports past company transactions, whereas the budget cycle analyzes the direction and aspirations of a company in order to project future transactions. Another way to differentiate between these terms is to consider the accounting cycle as a part of a process that allows a company to share its financial documents with external stakeholders, whereas the budget cycle is part of a process used internally among company's officials to determine the costs associated with future company activities.